Are you looking to maximize your investment returns? Investing is often seen as a daunting task, filled with uncertainty and risks. However, with the right approach and mindset, it can be a powerful tool for building wealth over time. While there are various strategies and tactics investors employ, there is one mistake that stands out as particularly detrimental to maximizing returns: letting emotions drive investment decisions. Emotions play a significant role in our decision-making process, and investing is no exception. Fear, greed, and euphoria are common emotions that can lead investors astray, causing them to make irrational decisions that undermine their long-term financial goals. Understanding and controlling these emotions is essential for successful investing. One of the most common emotional mistakes investors make is trying to time the market. Market timing involves predicting the direction of stock prices and buying or selling investments accordingly. While it may seem intuitive to buy low and sell high, the reality is that accurately timing the market is incredibly challenging, if not impossible. Countless studies and research have shown that even seasoned professionals struggle to consistently time the market. The problem with market timing is that it often leads investors to make impulsive decisions based on short-term fluctuations in the market. Instead of focusing on the fundamentals of the companies they are investing in, they become preoccupied with trying to predict market movements. This can result in buying high during periods of euphoria and selling low during times of panic, effectively locking in losses and missing out on potential gains. Another emotional mistake investors make is succumbing to herd mentality. Humans are social creatures, and we tend to look to others for guidance and validation, especially in uncertain situations. In investing, this often manifests as following the crowd and buying or selling investments based on the actions of others, rather than conducting thorough research and analysis. Herd mentality can lead to the formation of speculative bubbles, where asset prices become disconnected from their underlying value. During periods of euphoria, investors may flock to certain investments simply because everyone else is doing it, driving prices to unsustainable levels. When the bubble inevitably bursts, those who bought at inflated prices are left holding the bag. To avoid falling victim to emotional investing, it's crucial to develop a disciplined investment strategy based on sound principles rather than reacting impulsively to market movements or following the crowd. Here are some key strategies to help you avoid this common pitfall. 1. Diversification. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes, industries, and geographic regions to reduce the impact of any single investment's performance on your overall portfolio. Diversification can help mitigate risk and smooth out returns over time. 2. Long-term perspective. Focus on your long-term financial goals and investment horizon rather than getting caught up in short-term market fluctuations. Remember that investing is a marathon, not a sprint, and staying invested through market ups and downs is key to achieving your objectives. 3. Sticking to a plan. Develop a well-defined investment plan that outlines your risk tolerance, asset allocation, and investment objectives. Stick to your plan through periods of market volatility, avoiding knee-jerk reactions based on emotions. 4. Research and due diligence. Take the time to research and analyze potential investments thoroughly before making any decisions. Look beyond short-term trends and consider the underlying fundamentals of the companies or assets you're investing in. 5. Avoiding impulsive decisions. Before making any investment decision, take a step back and assess whether it's driven by rational analysis or emotional impulses. Avoid making impulsive trades based on fear, greed, or herd mentality. 6. Seeking professional advice. Consider seeking guidance from a qualified financial advisor who can provide objective advice and help you stay disciplined during turbulent market conditions. By avoiding the emotional pitfalls of investing and adhering to a disciplined approach, you can maximize your chances of achieving long-term financial success. While it's natural to experience emotions when it comes to investing, learning to recognize and control them is essential for building wealth over time. As legendary investor Warren Buffett once said, "Be fearful when others are greedy, and greedy when others are fearful." Thanks for watching. Please like, comment or share this video and subscribe to this channel about personal finance and investing.